I've used this line so many times before. I really think it's appropriate. What we're seeing here is the bursting of the last great bubble. So the next phase of this really isn't Japan. It's not so much about the end. You've already opened the Pandora's box. The next phase of this has to be a repricing of default risk and corporate credit, which, by the way, is completely consistent with what you see entering recession. We have the yield curve inversion. Yeah, it looks like it's finally coming, or if not, already here. That's why I keep saying I think the bigger event, the bigger main event, is still coming in, maybe a few weeks here.
Michael Guyette is back. He's the publisher of the Lead Lag Report. He was on the show, well, several times this year and last year, but he's been calling for the reversal of the yen carry trade. It's finally happening. It's been happening for quite a number of weeks now. Now, this was the call you made exactly a year ago on my show on August 1st, 2023. Take a listen. You also tweeted that the BOJ will either have to defend the yen again or risk severe inflation. No one is prepared. What exactly is going to happen? What is a domino effect? So why is Japan going to get inflation if the BOJ does nothing? What are they going to do exactly to intervene? What's going to happen to the yen as a result? What's going to happen to U.S. markets as a result?
It goes back to the mothra, not the butterfly. So if inflation were to keep on rising because oil denominated in yen keeps rising, if the yen keeps falling, they're going to have to step in to defend it. If they step in to defend it, that unwinds a lot of short covering in the yen, unwinds the carry trade, which conceivably means that people then have to sell off their investments in all risk-on assets, in particular, by the way, tech, again, given that correlation of the dollar yen to technology. And that then sparks conceivably a global margin call. Now, by the way, we are in August, September, October.
And it's finally culminated in what's going on today on Monday as we speak, with global markets selling off, Asian markets having their worst day since 1987. The Nikkei is down 12% on the day, on the trading day. Trading circuit breakers triggered in Japan and Korea. Here in the U.S., the markets are down. All markets are down. Risk assets, Bitcoin and gold. Bitcoin's down like 20%. Anyway, we're going to find out what's going on, what's next. Michael, welcome back to the show. And by the way, you've been calling for this for quite some time. You've been laughed at. Finally, I guess you've been made correct. Are you going to pop that bottle I gave you? Remember that ice wine that you said?
I got it right here.
You got it right.
I'm ready to go, man. And by the way, you sound really energized. I mean, I'm not really panicking in this, although I will say that for whatever it's worth, I myself have been nervous about the way this would play out. I'm the first one to say path matters more than prediction. All right. So I'll say out of the gate, the majority of my funds got this right from a rules-based perspective. One did not, unfortunately, which is why I think there's still more pain to come, because typically in advance of a major decline, all the signals I'm known for will line up. But yeah, listen, I give you credit. You were the first one I spoke to about the reverse carry trade idea back in August of last
I
year.
was just in the right place at the right time, I guess.
Yeah, and it's amazing how quickly it happened, slowly then all of a sudden, which I kept on
Yeah.
saying repeatedly.
Yeah. Give us an update on what's going on right now for those of us who haven't been following the story.
So it's funny to me because now everyone's an expert on this, and to your point, I got ridiculed ridiculously on this. The idea was very simple, right? You have a monetary cycle mismatch between the Bank of Japan, which is the world's enabler of leverage through the carry trade, and every other central bank around the world, and that at some point the yen would squeeze higher, cause a reversal of the carry trade as money panics, as Japan panics, which is clearly what's happening now. And that would have all kinds of nasty reverberations. I call Japan the Mothra, not the butterfly flapping its wings to creating the hurricane in a chaotic system. It's the Mothra from the Godzilla movies. So it looks like in the last three trading days, that's exactly what's happened. You've had some shocking moves, seemingly out of nowhere. I look at it this morning. It's like the VIX crossed what, 60, I think it was, at the peak before, just as the market was opening. Now, this is, I think, very, very tricky, extremely tricky. I go back to, again, path matters more than prediction. The problem here is people are under the assumption the Fed's going to step in and print money. And you know what? It makes sense that they're going to have to try to ameliorate some of this volatility, which seemingly came out of nowhere. But again, the conditions have been there for a better part of a year. They just happened suddenly. The problem is that this is actually very much a catch-22. If the Fed lowers rates in response to the reverse carry trade, that actually narrows the interest rate differential between Japan and the US. That interest rate differential is what is causing the yen to fall, or what caused the yen to fall before, and now is actually causing the reversal of it. So if the interest rate differential is narrowing, that's actually yen supportive, which could actually accelerate the reverse carry trade even further. So I suspect there's going to be some degree of intervention, some kind of swap line or something's going to be announced just to kind of cool things off in the short term. But the cat's out of the bag, right? It's like once you have a deleveraging process like this, it's very hard to really contain it. And this was the whole thesis I had with you when I was joking about the whole world being by this. I said you have to laugh about it, okay? But it's a very serious situation because it's going to be very hard to manage.
The Bank of Japan, have they actually intervened? It was a suspected 6 trillion yen intervention. Any conclusive evidence now? We talked about this 2 weeks ago, by the way, but things are really starting to play out now.
I am certain that they did. I'm actually surprised by how hawkish they got, right, on the most recent decision in terms of the terminology. I think they are now going to regret that hawkishness.
Wait,
Look,
what do you
this
mean
is
hawkishness? Are you referring to the 0.1% rate hike or something
yeah,
else?
and alongside the slowing down of bond purchases, alongside the rhetoric that they're going to keep
Okay.
on basically raising rates until they've squashed inflation, which again, the whole thesis was what oil price in yen is the problem. So if they keep letting the yen fall, oil skyrockets. That's problematic for Japanese savers who are already choking on the inflation side of things without the commensurate wage end of things. So it does seem to me like the reverse carry trade is here. Now, how it plays out is going to be really, really tricky. I would not be surprised at all to see the markets rally substantially this week. Okay, because the initial reaction, if there's some kind of central bank intervention, is they're going to save the day again. But again, the problem is anything they do, I think, will ultimately exacerbate the dilemma. The dilemma is you can't really lower rates when this is purely about leverage caused by an economy, which is the latest to hiking rates in this cycle when everybody and their mother and their pet hamster was borrowing from them to deploy into Nvidia. I mean, that's just the harsh reality about the situation that we're in. It's not one of those situations where I think it's going to be like an '08, a cataclysmic type of scenario, but it's going to be painful and it's going to be volatile and it's going to throw a lot of people off.
Let's pause for a minute and take a quick snack break. Have you ever wished you could enjoy restaurant quality meals at home without the hassle? Well, let me tell you about today's sponsor, Cook Unity. It's the first chef to consumer platform that delivers freshly prepared, pre-selected meals to your door weekly. Cook Unity partners with award-winning chefs from across the US to bring you an at-home gourmet dining experience like no other. For example, you get this garlic butter chicken with broccoli made by Chef Tony Perez. Their meals are thoughtfully curated using real ingredients. There's nothing artificial. With options for every dietary preference, including vegan and gluten-free, you can enjoy a variety of delicious, inventive meals. Plus, the subscription is super flexible, allowing you to pause, skip weeks, or cancel anytime. The meals are delivered fully cooked, so all you have to do is heat them up. If you're ready to try it out, go to cookunity.com/David50 or scan the QR code here on the screen and use my code David50 to get 50% off your first order of Cook Unity meals. Okay, let's take a look at what happened. This is from Reuters 9 hours ago. Bank of Japan made hawkish tilt, debated inflation risk in June. Minutes show this is exactly what you were talking about. So at least two of the Bank of Japan's 9 board members called for an early interest rate increase at a policy meeting in June. Minutes showed on Monday, underlying the central bank's hawkish tilt that provides scope for further hikes ahead. Okay, boy, further hikes ahead. So does that mean further yen appreciation, further capital rotation out of U.S. markets? That's what we're wondering right now. Further rate hikes ahead. What does this mean for us?
Part of the thesis was that the risk is that you have an uncontrollable short squeeze in the yen, that the yen does keep on appreciating because the starting point of all of this was a lot of short speculative positioning on the yen to begin with, which was the carry trade, people borrowing in Japan and then that currency weakening, which as a borrower you loved, but now you hate because the yen's going against you in terms of paying back that loan. So yeah, and now I don't see how the Bank of Japan can step away from that kind of rhetoric. I mean, what they're going to just totally flip 180 and then suddenly go very dovish after a few short trading days. You know, even the Fed in this. Let's think through this from the U.S. perspective, right? From the Federal Reserve standpoint. So Powell basically assured us that September there will be a cut, and he's kept on assuring investors, economists, traders, soft landing, soft landing, soft landing. So what? 3, 4 trading days later, now that entire narrative is flipped. I mean, talk about central bank credibility. I've used this line so many times before. I really think it's appropriate. What we're seeing here is the bursting of the last great bubble. The last great bubble is faith in central banks to solve all problems. They are the source of this problem. They are the enablers in terms of leverage. Any momentum, any PE expansion, any FOMO is not being driven by cash. It's being driven by borrowing. And at some point, when that reverses, it reverses in a very sudden and ugly way. Again, I am hopeful that at least in my own funds, I can navigate through this given the nature of the strategies. The majority of my funds have got it right, but it's as tricky. And even for me, I'm scared out of my mind in terms of what comes next.
Why are you scared of your mind? What's well, you're mostly long treasuries, right? So are you
My,
talking about that area?
no,
Yeah.
but the issue is that if it happens all in one week, right? And you happen to miss that week, okay, which is a legitimate crash, it becomes a real problem. My signals are designed to get ahead of that more often than not, but in the small sample, it's not impossible to see the exact opposite. This is my point. It goes back to that third time I was saying path matters more than prediction. You can get the reverse carry trade right, okay, but if you're going to have a huge advance with a huge decline, another huge advance, and all this seesaw from a trading and management perspective, it's like Neo, right? Dodging bullets, and you're still going to get nicked.
Okay, so let's break down the rest of this conversation into buckets. The first part, we're going to talk about the economy, and then ultimately what's going to happen to the different markets that have moved the most in the last couple of days. First, on the economy, the Japanese economy first. So the Bank of Japan, we've talked about the Bank of Japan. If the yen continues to appreciate, what's going to happen to their economy? What do you think?
It's actually really so I did a whole interview with Weston Nakamura yesterday, who's out in Japan, right? And it's actually really interesting because the way that the banks have collapsed in Japan is actually disturbing, right? And it has shades of '08 from that perspective in terms of their own economies. Now, I don't think it's going to get as bad, but if you get to a point where it creates real fear and bank runs in Japan, that's not a good thing, folks, and it's not outside the realm of possibility. So economically, first of all, let's be very clear. The way markets are reacting is deflationary. So the funny thing about the Fed, Bank of Japan wanting to be hawkish, okay, is that they got their rate hikes in the form of a drawdown in their stock market, right? It's the reverse wealth effect. Same thing in the U.S., right? Even though the S&P is still positive, right? More of a side note, by the way, it is amazing. Everyone got so sucked into this small cap rotation narrative from a month ago, just before all this hit. I mean, I can't help but laugh and smile at how this is just proof that markets screw everybody, right? And you can never assume things will continue into the future the way they have in the past. So economically, I think Japan is probably going to be in some serious trouble. And it is a very nasty setup for the US as well, because now if the Fed is going to try to cut rates, it's still not clear just yet if we've defeated inflation. So what if the Fed now is the next one to make a major mistake? They respond to this with some liquidity, which is often how they respond to crises, but then that creates a bigger bubble down the line. I mean, maybe the best thing to do is just take the pain and wait.
There's been speculation now that this is just a temporary dip. We're going to talk about your market outlook in just a bit, but let's talk about what the Fed may do. Does the Fed need to issue an emergency cut before September? That's something I've heard on CNBC and some other channels
Rumors.
today.
Yeah.
Yeah.
I don't think it's outside the realm of possibility. I think it would be a tremendous mistake. Because again, I think the unintended consequence of that is going to be it's actually going to make the yen stronger because of that narrowing of interest rate differential. Right. But is it possible? Yeah, sure. I mean that they step in. Look, I've made this argument actually for the last several months. I said Japan will be the Fed's scapegoat for lowering rates in such a way that they can say they are lowering rates not for political reasons, but because of forces outside of their control. The force that's outside of their control is all the leverage that the carry trade enabled. So you can make an argument that Powell actually wouldn't mind this just to save face, right, from that perspective. But at the same time, I don't think any of this is healthy or positive, like at all. I mean, this is something which is far more consequential than people realize. The carry trade from Japan, and this one was part of that clip that's on my pinned post on X at Lead Lag Report. The carry trade was one of the reasons the '08 crisis happened. I mean, it's so funny to me that everyone's now an expert on this, and it's like you and I have been talking about this for a year, not 2 years, like some people say. Literally a year, and I've been on this point repeatedly. It's playing out the way I thought it would, but it's still going to be tricky. But either way, the coming out of this, it's very hard to manage.
Wait, the carry trade was partly responsible for 2008. Can you explain?
Yeah, no, and actually, I go back to that pin post. You were even showing an IMF paper that was written explicitly mentioning that
That's
idea,
right.
right? If you remember the back in that video, when again I was 90 pounds
Yeah,
heavier.
I'll replay it in my video replay. Yeah. Oh.
You highlighted a paragraph from an IMF article, and the
Yeah.
abstract reads: the financial press at the time I think we're talking about the 2008 2008 credit crisis, referred to a collective margin call on the United States in which foreign creditors sought to reduce their exposure to the deteriorating creditworthiness of U.S. borrowers. This paper argues that the carry trade should instead be viewed in the broader context of global credit conditions. What does all this mean?
It means we're all. I don't know how else to say it. It's like
Yeah, but yes.
it only took me having to lose nearly 100 pounds to be right on this damn reverse carry trade. I mean, that's clearly what's happened in my life. Look, now the question is, what do you do about it? Okay, so things are
Yes.
volatile, right? Okay, I keep going back to shorting does not work. Okay, because there's this concept, there's this idea. It's a well-known phenomenon. It's called volatility clustering, which is to say that markets that go down heavy tend to be up heavy, and then down heavy, then up heavy. So they whip around like crazy. I've been saying repeatedly, this environment is going to throw bulls and bears off. Right? This is going to be very difficult for both sides of it because that's the nature of volatility. That's why shorting doesn't work. It's not so much about trend; it's about the back and forth aggressive swings. So I think from a conceptual perspective, if you're going to be long only, or you want to just take some risk off the table, risk off being default risk off, then gold, treasuries, the dollar itself, utilities, those all make sense. I've used those before and referenced those as imperfect hedges in the past. Long duration treasuries have gotten some real fire for all the narratives over the last year and nonsense I've been seeing around people saying the flight to safety trade in treasuries is dead. They're all quiet now. It would never die. The only thing that was missing was widening credit spreads. Now, we should touch on that too. The entire thesis wasn't about Japan. The thesis was that Japan would spark the event. But the event comes from junk debt. The most mispriced asset class in the United States is high yield junk debt paper. Junk debt paper that, for the longest time throughout this duration collapse, has been saying there's no default risk, there's no credit risk. Money's gone into private credit. A lot of money probably being funded from Japan through the carry trade into private credit, all while small caps have gone sideways. All while the vast majority of stocks have been nervous about default risk, which is why they never participated in the Mag 7 run. Small caps, due to zombie company dynamics, have been worried about default risk. Credit spreads have not. For Japan to spark this volatility, it sparks the widening. So the next phase of this really isn't Japan. It's not so much about the end. You've already opened the Pandora's box. The next phase of this has to be a repricing of default risk and corporate credit, which, by the way, is completely consistent with what you see entering recession. We have the yield curve inversion. Yeah, it looks like it's finally coming, or if not, already here.
Okay. Bank of America, U.S. high yield index option adjusted spread. It's at 3.72%, up a lot over the last couple of weeks. It's still nowhere near, Michael. It's still nowhere near like pre-2023 levels.
Right, right.
So,
It's early. Yeah, no, you're exactly. It's early. I would argue it's the start. That's why I'm not as convinced that you just kind of fall straight through. You need more widening on the credit spread side to justify a larger decline, at least very, very short term. And I know it sounds confusing because people are like, you called the reverse carry trade, but you sound bullish. It's just a different time frame. I just think that you're going to get whipped around, so it's not going to be that easy to think that stocks just hammer down straight through unless it really is some cataclysmic 2020 type of environment. I don't think it's going to play out like that. I think it's going to suck in a lot of people and then hurt a lot more people afterwards. But you
okay, so
need
let
to have those spreads widen much more, to your point.
okay, so let's clarify right now. Risk assets selling off, as we know, stocks. What is the immediate impact of this reverse carry trade continuing, I guess, in the next couple of days? Is this sell off going to continue? Is, I guess, the question that people are having right now, or people should buy the dip? That's another argument I've been hearing, right? This is a great buy the dip opportunity.
Whoever says this is a great buy the dip opportunity, first of all, needs to disclose how much cash they have because you can't buy the dip unless you have cash to deploy it. And everybody was already all in, right? I think when you look at the sentiment numbers, the leverage, all this stuff. Um, it's buy the dip, but then when do you sell the rip? I mean, it's two decisions, right? As far as how that plays out. I think short term, it's probably very, very overdone. Okay. And I think the fact that everybody is suddenly an expert on the reverse carry trade, the same people who attacked me and mocked me and insulted me, not understanding that my views on markets and analysis are different and separate from my funds, which are rules based. Okay. Now suddenly they are bearish and experts. It's like, you know what? Along the lines of what Marty Zweig says, markets will do whatever it needs to do to screw the most number of people. So if everybody now is suddenly bearish, it's probably time to start, from a short term perspective, maybe getting a little bit contrarian on that end. Having said that, this is a very dangerous environment for anybody to play in because I can make an argument either way. You can make an argument that this is a cataclysmic deflationary once in a generation event because the carry trade has lasted as long as it has, and it seems like it's very hard to reverse now, the reversal of that. Or you can make an argument that, hey, you know what? There's still a ton of liquidity. They're going to find a way to resolve it, and we'll be okay. I don't know which way it's going to play out. I'm not a doomer. All I know is that the conditions right now are it's raining, and when it's raining, you can still tactically speed up.
Treasuries. Okay, so the treasuries have risen over the last couple of days, starting Friday, actually, not even today,
Yeah.
but starting Friday, they've been going up. Yields have been coming down a little bit. What's happening next?
Yeah, and actually, it is interesting, right? So if you look at when the yen bottomed, it's exactly at the time that long duration treasuries relative to the S&P 500 started rallying. It's all the same trade, okay? Meaning, as the yen has rallied, you've seen that outperformance of long duration treasuries against the S&P. Also, the same trade that Nvidia started weakening as the yen started appreciating. Not a coincidence with all this stuff. The thing is, when you look at treasuries relative to equities, it's been a big move, but the move is nothing in the context of just how badly treasuries have underperformed equities since 2020 throughout this rate hike cycle. So I would not be surprised at all to see treasuries continue to outperform. Now, the key term there is outperform. That does not necessarily mean I expect the yields are going to collapse further from here, at least not right away. Treasuries on the long duration side might hold, while the denominator stocks go lower. Right? It's a question of sort of how the outperformance takes place. It could be down less, it could be up more. I suspect a lot of the initial gains in treasuries are probably done. But hiding out in treasuries is probably not a bad idea because everyone's still so bearish on the idea that government debt you can actually park some capital in. You can. All these narratives were just flat out wrong. They were chasing the moment, not the reality.
What do you think is going to happen to treasuries from the Bank of Japan perspective? Are you surprised, first of all, that treasuries went up? Because the narrative or the assumption with theory is that the Bank of Japan would sell
Oh,
treasuries
right,
in
right,
order to prop up the yen.
right.
Is that happening?
So I made that argument myself. I
Yeah.
said, I think the sequence of this is that they'll sell treasuries, okay, which will put some upward pressure on yields. But then at some point, then that becomes a scare that pushes money out of risk on assets, which pushes money back into treasuries. I think there's an argument to be made, and this is not me putting some excuse. I think there's an argument to be made that they were doing some of that, but it was starting to get absorbed by scared capital as they were selling into it, right? Because it was, if you notice just the way treasuries against the S&P moved since the start of July, it was like really gradual, and then suddenly an explosion. So it seems like one of those situations where they may have been selling into that very quietly, okay, as and using that as the fuel, basically the dollars, to buy up at the end, right? So it is playing out, I think, largely the way I thought it would. Um, but again, it's so unclear to me how the path plays out on a go-forward basis. The one thing I'm confident in is that just as everybody's focused on the yen, the thing that people are ignoring is the behavior of junk debt, and it all starts and ends there.
What do you mean ends there? What ends there, Michael?
Meaning that what causes the reflation trade, the liquidity tsunami, is when you have junk debt high yield spreads blowing out because that's what the Fed cares about. When the bond market is basically saying there's bankruptcy risk, there's default risk from a corporate credit perspective, that's what causes seize ups in the economy. That's what the Fed is designed to try to prevent and counter because that inherently implies counterparty risk is rising, which means people do not want to transact. Businesses do not want to transact. On a side note, as much as Bitcoin has gotten utterly destroyed in this, as well as other cryptocurrencies, I'm going to make another argument, which is if I'm right about all of this playing out the way that I see it, Bitcoin may actually diverge, meaning Bitcoin could actually, oddly enough, in this cycle, be the risk or one of the risk off plays. Now, the reason I'm saying that as somebody who's anti narratives around inflation hedge, anti narratives around store of value, all these are nonsense terms that don't abide by actual real definitions. I do agree that Bitcoin, like gold and like treasuries, are a counterparty hedge. And in credit events, which is, I think, what Japan is sparking, is entirely about counterparty risk.
Okay, so like I mentioned, credit spreads aren't widening yet. What's the catalyst for this widening?
I think it's just going to be a function of time. I mean, it's already started, right? The issue is when you talk about junk debt and high yield credit, they tend to be relatively illiquid. So it's the same kind of idea, slowly, then all of a sudden. There's some selling that takes place. Suddenly it becomes bigger amounts of selling that begets more selling, but there's not enough liquidity beneath the surface to bid it up. right? So I
Okay,
think it's going to be more a snowball effect.
I'm just trying to understand the mechanism here. So
Yeah.
walk us through one more time, please, the transmission from the Bank of Japan and the reversal of the carry trade to credit spreads widening in the U.S. Now, credit spreads usually revolve around some sort of higher risk of
Right.
delinquencies of credit in the U.S. So how's the Bank of Japan related to delinquencies of credit in the
Yep.
U.S.?
If you were to overlay the VIX index
Okay.
against credit spreads, if you look at the Fred website, and you can probably show it after this video, if you'll see a one-for-one relationship, meaning when the VIX spikes, credit spreads widen. The bond market, the volatility is credit. I mean, that's the point. There's a strong relationship there. So the bond market interprets default risk as rising when the VIX spikes. I'm pretty sure we just saw what I think the third largest VIX spike since the 90s, right? I think this whatever happened this morning was under the 2020 level and it was under the '08 level, but was pretty much up there. That's what starts it, right? It's that volatility transmission mechanism.
This sell-off of the tech stocks and broader equity markets in the US have been happening ever since the middle of July. Ever since July
Yeah,
11th, the CPI numbers came out.
right.
And so the other narrative, which we're going to address now, is the fear of a recession in the US, which really were more confirmed. These fears were more confirmed last Friday as the unemployment report came out. 4.3% unemployment, SOM rule triggered.
Yeah.
So that's been a near perfect recession indicator in the past. What's your view on how the markets are reacting to US domestic economic growth?
Isn't it funny? Speaking about getting mocked, I said the lags are starting to hit repeatedly, and they are starting to hit. This is my whole point. It's why I never gave up on the thesis. You were still in the lagged window of the fastest rate hike cycle in history, causing an accident. And just because it didn't happen on a bunch of random people's time frames never meant that you were out of that window, right? So you're exactly right. And combined with the uninversion, by the way, which is also kind of a fait accompli around a recession. I remember I put a post out on Instagram at Lead Lag Report, and I said something along the lines of the lags will hit when everybody expects they never will. And we got to that point entering July. Everyone started screaming soft landing. I mean, you can't make this stuff up. Markets have been almost classic in terms of proving that nobody can predict the future, that the crowd is wrong at the extremes. We're living it right now. And just in the same way that everyone's now wrong, I think, in sentiment wise, short term, saying bearish, reverse carry trade, everything I've been saying they're parroting now. Yeah, they're probably going to rally and then hit it again because that's what markets do. But you're right. The economic dynamics are still weak and they're weakening further. And all the hope around the Fed trying to liquefy the system assumes that they're not only going to get it right just in time, but the lags of them cutting rates would coincide with the lags of the fastest rate hike cycle in history, when neither is an exact science. It's actually complete lunacy to think that the Fed can possibly manage a soft landing when they don't know when the lags hit themselves on the hike side or on the cut side.
Yeah, projected cut by September, at least one cut. You know what's funny because when the FOMC kept rates unchanged last Wednesday, a reporter asked Powell, "Will you cut by 50 basis points?" He said that's not on the table. CME Fed Watch tool priced in like 70% chance of a 50 basis point cut. 2 days later, when on Friday when markets fell after the jobs report came out. Now on Monday, I'm hearing rumors of a 75 basis
Yeah,
point cut.
why
And what?
not? Yeah, why not? Watch how quickly the narrative changes. I mean, that's really what's happened in this. It's complete insanity. The whole world has lost its mind on this. I mean, how can anybody have any confidence? It goes back to the last great bubble, faith in central banks. How can anybody have any confidence in Powell if it's that kind of a 180 type of monetary shift? It's complete lunacy. So and again, I think it would be a mistake if they do that, right? So again, this is a very volatile juncture. Volatility means it hurts both ways, up and down. The Fed, I think, is going to get caught here. Okay. And whatever they do next is going to have other kinds of implications and unintended consequences. Either way, the Mothra is flapping its wings. Okay. It's the start. It's not the end.
If the Fed cuts, let's say by September, would that not exacerbate the reversal of
Yeah.
the yen carry trade? I think you just talked about that. And the logic here is that, look, the differentials of the interest rates are going to widen even more. And so a cut is not actually great for risk assets in the US. What's your take on that?
Which, by the way, is totally consistent with all the charts everybody shows that most drawdowns have to happen after the Fed cuts rates. Now, by the way, rates are already being cut. This is the other thing which drives me crazy about these narratives. The Fed does not own the bond market. The bond market owns the Fed. The Fed is a follower. It is not a leader. So, yeah, you know what? 50, 75 basis points cuts, that's not the Fed deciding that. That's the bond market deciding that. And the Fed then is going to basically just do what the bond market itself is saying. All right. So it just goes to show you just how fragile recency biases can be, right? Everyone assumes suddenly that soft landing, and then all it took was 72 trading hours for everyone to say, oh, well, you know what? I guess we're going to have to cut aggressively after all. Oh, and it's going to be bullish. I don't know. We'll see. The idea that it's even on the table should make everybody question any central bank's ability to forecast the future after the last week or so.
The lumber to gold ratio kind of correlated
Yeah.
inversely with the unemployment rate. The lumber to gold ratio has been falling, unemployment rate's been rising. Is this just a coincidence?
No, and again, my unfortunately my Roto ETF, which uses that signal, I had been risk on because lumber to gold on a very short term basis was strong. I was purposely saying throughout this utilities hold the key because utilities as a risk off signal looked more like it was telling the real story as far as volatility to come, which is what my JoJo ETF, my bond ETF, which I hope people do consider, has gotten this right, right on time. Um, I, the lumber to gold dynamic will very much factor into housing and risk off sentiment. The interesting thing about this is, as we've seen yields fall, mortgage rates have, of course, collapsed because mortgage rates are connected to the 10-year. Home builder stocks are really, really weak, like really weak, which tells you that, and lumber is also starting to re-weaken again. So my point is that it seems like the hope of lower mortgage rates giving a boost to housing, no, not so much. It looks like it's going to be quite the opposite. It's weaker demand. Gold, I think, is going to be really important here, just from the standpoint of can it hold its gains? I'm actually not expecting gold to really rally substantially, like in the very short term, with all this volatility, because going back to the transmission mechanism, when you're faced with uncertainty and volatility, and got a bunch of asset classes, you're going to sell whatever's working. Well, gold's been working. High yield junk debt's been working. Another example of how that can be a source of liquidity as everything else is acting more volatile. So if gold were to hold, I view that to be very bullish. And if gold holds while lumber again resumes its decline, at least on a short-term basis, which resyncs Roto against JoJo and my mutual fund, ATAX, then that's why I keep saying I think the bigger event, the bigger main event is still coming in, maybe a few weeks here.
A bigger event is coming in a few weeks. Well, we're going to get you on a couple of weeks to see how this bigger event is playing out. Ultimately, then, ahead of this bigger event, okay, are you going to open that today?
I will. I'm actually no. I'm fasting until Tuesday. So if I do this today, I'm going to pass out. Which people I'm sure. Will
All right, we'll do it.
I'm already going viral on X apparently now. So it's like maybe I'll throw that in the fire.
We'll do it. We'll do it next time. Ultimately, asset allocation ahead of this potentially bigger event.
I think you want quality, generally speaking. Okay, again, shorting does not work. Quality meaning not anything that really has.
Wait, so I have to stop you here.
risk.
What
Yeah.
do you mean shorting does not work? I mean, clearly, if you shorted, it would have worked as of today. I mean,
Yeah, in the last 3 days, sure. But if you try and short now and then the market rips higher, which is a very distinct possibility, right?
I see.
I'm not saying you undo the entire loss.
I
But
see.
could you have a very shock move higher? Unequivocally, yes. And I've done all kinds of back tests on this. The volatility clustering idea. Shorting is wildly dangerous. Wildly, I don't care how bearish anybody is. Be careful. Like you might get it right. Just be careful. But no, I think yeah. So I think trading smaller if you're going to trade, probably raising some cash might make some sense for some investors, and just being more conservative. Look, even before this started, the utility sector was really rocketing. I mean, it was actually up more as the market was advancing. And it's actually done really well throughout this as a sector relative to the broader S&P 500. Utilities, which I've written about and put a paper out on as a signal and as a way of playing volatility. So, like, you can still be exposed to stocks, be in utilities. If stocks go down, hopefully they'll be down less or maybe even positive, except in extreme declines. If stocks rebound, utilities are still stocks. So they'll probably participate anyway. My point is you can play this without the dangers and risks of making a directional call.
Well, where can we follow you, Michael? Get more of your updates. I'm sure you'll be busy with the updates in the next couple of days.
At Lead Lag Report on X, YouTube, Threads, Instagram. David and I did this kind of last minute. I sent him a DM saying we need to do a talk right now because again, I go
That's
back.
right.
David is the guy. I give him all the credit in the world. He is the guy that brought it out of me in August of last year. So if anybody's going to associate the reverse carry trade to me, you got to make sure you follow David, subscribe to his channel, and also follow him on X.
I
And no,
appreciate it.
and then of course Substack, leadlagreport.substack.com. Look, I am first and foremost an entrepreneur, a portfolio manager. I've got funds. I've been very public about the cycle that I've been in because they have to be in treasuries. And last 3 years have been brutal from that perspective. The one thing I am most confident in, which I think is a good place to end this conversation, is that the cycle's changed. The cycle has changed. And when I say the cycle has changed, what I'm really referring to there is that there is new leadership. That's all I need to have a chance.
Okay, well, let's end it here. I mean, yeah, you brought up your fund several times. Yes, the performance of some of your funds like Robo haven't been great. Have you ever considered changing the rules? I mean, you said they're rules based. Your personal convictions have been right. Why not just change the rules? I guess I don't know.
Aside from the fact that that requires shareholder approval, and aside from the fact that it's more about the opportunity set, not about the rules, I can almost promise that if I were to go down that road, it would all start to work because that's how it is with markets. It's like the moment you give up on something that you believe in, that you've tested, is the moment it turns. So you can't relent.
All right. Well, congrats on what turned out to be a very good call. And we'll make sure to get updates from you as this event unfolds. So thank you for joining us today, Michael. Good to see you, and we'll see you again soon.
Appreciate it.
Thank you for watching. Don't forget to like and subscribe.